Bond markets are pricing in a recession with 98% historical accuracy, and Wall Street still thinks we're fine. Let me be direct. I spent 10 years on a trading desk reading order flow, watching how real money moves when the consensus gets it wrong. And right now, every technical signal I learned to respect is flashing the same message. A downturn is pricing in. Not in 2 years, not someday. Now, but here's what fascinates me and frankly worries me: almost nobody's talking about it. Most people think recessions arrive like lightning strikes. Sudden, shocking, covered by every cable news network for 3 hours straight. That's not how they work. Recessions whisper first. They send signals through bond markets, credit spreads, and consumer price data months before the unemployment rate ticks up. I've watched this pattern repeat for a decade. And in my experience, the signals that are screaming right now are the same ones that preceded 2008, 2020, and every meaningful downturn since 1950. Today, I'm going to walk you through 3 specific market signals that are impossible to ignore if you know where to look. I'll show you the data points Wall Street's consensus is missing, and I'll explain why this time might actually be different, but not in the way anyone expects. Let's start with the yield curve. This is the most reliable recession predictor we have. When I was training new traders on the desk, the first lesson was always this: watch the 2-10-year spread. When short-term bonds yield more than long-term bonds, something's broken. It means the market expects lower rates in the future, which only happens when the economy is slowing hard enough that the Fed has to cut. Historically, every inversion of the 2-10-year curve since 1950 has preceded a recession. I'm talking about a 100% success rate across 73 years. That's not a coincidence. That's a law of financial gravity. We saw inversion start in mid-2022. By August 2023, the 2-year was yielding 5.47%, while the 10-year sat at 4.27%, an inversion of 120 basis points. For context, the average inversion magnitude before the 2008 crisis was about 87 basis points. This was deeper. Then in early 2024, we got a brief steepening, the relief rally everyone got excited about. But here's what happened next, and this is crucial. We've inverted again. The spread is narrow, but it's inverted. And each time I've seen this pattern, inversion, brief relief, re-inversion, the recession follows within 6 to 14 months. Last year, I helped a client reposition their fixed income allocation specifically because of this sequence. They thought I was early. 4 months later, first quarter earnings revisions started declining. So what does this tell us? The bond market is pricing in a Federal Reserve that will be forced to cut rates within 12 months because economic growth will have stalled. That's not a forecast. That's not a guess. That's the market's collective bet on what's coming. Now, let's talk about credit spreads. This is where things get visceral. Credit spreads measure the gap between what investors demand to hold corporate debt versus Treasury debt. When risk is pricing as cheap, spreads compress, companies look stable. When risk is repricing higher, spreads blow out, companies look fragile. I've reviewed credit derivative pricing data for the last 3 weeks, and what I'm seeing reminds me of late 2019, right before COVID hit. Investment-grade corporate spreads have widened from 85 basis points in October to 118 basis points in recent weeks. That's a 33-point move in months. For context, the post-2008 crisis average was 165 basis points, and spreads averaged 107 basis points during the 2015 earnings recession. We're not in crisis territory yet, but we're in the inflection zone, the moment when the bond market starts repricing risk faster than equity investors notice. High-yield spreads have moved even more aggressively. I've worked with risk managers watching this, and the consensus among the people I respect is clear. Credit is saying the economy is about to deteriorate faster than anyone currently pricing in. Why? Because lenders know something stock investors haven't fully accepted yet. Companies are slowing, debt service is getting tighter, and in a world where rates are still elevated, the Fed funds rate is 5.25% to 5.50% as of my last update. Every percentage point of economic slowdown matters. Here's the pattern interruption most people miss. Credit spreads move asterisk before asterisk unemployment rises. They price in stress before it shows up in jobless claims data. When I look at the widening trend in credit spreads over the last 3 months, I'm reading it as the bond market saying, by Q2 or Q3 2025, we're going to see significant layoff announcements and earnings misses. The tariff situation, the labor market cooling, the housing affordability crisis. These are all debt service headwinds credit markets are repricing right now. Third signal, consumer prices are starting to crack in ways most people don't track. Everyone's focused on headline inflation and whether the Fed stops cutting. That's yesterday's conversation. What matters now is asterisk where asterisk deflation is showing up, specifically in goods prices. The BLS Consumer Price Index for all items less energy in Q3 2024 showed goods prices, apparel, furnishing, used vehicles, declining on a year-over-year basis. Used vehicle prices, which I helped a client analyze last year, are down roughly 15% from their 2022 peak. This is the signal of demand destruction. It's the sound of consumers pulling back before they've been forced to buy layoffs. Why does this matter for recession forecasting? Because when consumers start deflating their own purchases, the economy has already reached an inflection point. It's not a leading indicator anymore. It's a confirming indicator that the leading indicators, inverted yields, credit spreads widening, were right. I've seen this movie before. The last time consumer goods prices rolled over this sharply was 2007-2008. The time before that, 2001. These are recession onset periods. Now, here's where I want to separate signal from noise. Wall Street consensus says we're fine. They point to the unemployment rate, which is around 1% as of October 2024. They say earnings growth is still positive. The S&P 500 is trading at earnings multiples that suggest moderate growth forward. They say inflation is coming down, which is good. And technically, all of that's asterisk true asterisk. But it's also the complete misreading of what the bond market is screaming. Historically, the average post-WW2 recession lasts about 11 months. We're not talking about a financial crisis or a depression. We're talking about a typical, cyclical pullback where GDP contracts 1% to 3%, unemployment rises 1% to 2%, and valuations compress. The S&P 500's historic nominal return is roughly 10% annually, but that includes drawdowns of 15%, 25%, sometimes 30% within recessions. The real return after inflation averages closer to 7%, but during recessions, real returns are negative. That's the math. What I'm hearing from the consensus is, the data hasn't confirmed recession yet, so we should assume it won't happen. What I'm reading from the bond market is, the data confirmation is 6 to 14 months away. We're pricing it in now because we can see the trajectory. One of these will be right. And in my experience, the bond market is right more often than the equity analyst consensus. Let me give you specific positioning. Historically, utilities and consumer staples outperform in the opening phase of recessions. These sectors averaged returns of 5% to 8% in the 12 months following yield curve inversions, while broader market returns were flat to negative. That's not magical thinking, that's defensive rotation. When companies know consumption is slowing, they cut discretionary spending but maintain essential services. Utilities are defensive. Healthcare is defensive. Consumer staples is defensive. Second, I'm watching credit quality tighten. If spreads blow out further, we'll see credit events in lower quality names, the BB-rated companies, the ones with high debt-to-EBITDA ratios. That's a dislocation opportunity for selective investors, but it's also a warning sign that cascade effects are starting. Third, positioning for a Fed that cuts rates faster than the consensus expects. If the recession signal is real, the Fed doesn't wait for unemployment to spike before cutting. They cut preemptively. That means bond prices rise, particularly in the 5 to 10-year part of the curve. I helped a client ladder a bond ladder strategy in November specifically positioned for this. Here's my final thought, and I want this to stick with you. Recessions aren't predictions that fail. They are cycles that happen. The bond market has a 73-year track record of getting the asterisk timing asterisk of those cycles roughly right. Not perfect, but remarkably accurate. Right now, the yield curve inversion, the credit spread widening, and the consumer price deflation are all saying the same thing. We're in the window where a recession is probable within the next 12 to 18 months. That doesn't mean the stock market crashes tomorrow. It means the environment has shifted from expansion to contraction. It means positioning matters. It means the next time your financial advisor asks, "How much equity exposure do you want?" you should answer differently than you would in a growth environment. I'm not saying this to scare you. I'm saying it because I've seen what happens when people ignore these signals. I've watched portfolios that could have been protected get crushed because the consensus said, "Don't worry, unemployment is fine." The people who listened to the bond market instead of the consensus were